Hi, this is Alan Laupsch with FNA, and I'd like to introduce FNA Correlations. Today, we're going to look at the very high systematic risk that we've seen across global equities. You can see the risk peaked at 79% on the 2nd of February, meaning that 79% of the risk of all of these different markets was explained by one single factor. So really we're in a situation where there's very little diversification benefit between different countries. What you see in front of you here is a correlation network. The links represent correlations, so links that are close together, like US and Mexico with a 0.89 correlation, have very high correlation, whereas links that are longer, for example, Thailand to New Zealand with only a 0.65 correlation, have a lower correlation. Negative correlations would be represented in red, but we don't see any negative correlations here. We also provide some alerts. For example, here we can see that on Friday, Turkey surprised to the downside. We can get some information about Turkey, and we can see here that this was the first negative surprise in 20 days. Turkey had done actually quite reasonably well. It had two positive surprises over the last 20 days, as judged by 95% confidence level outliers. Over the last 100 days, we've seen 6 positive surprises and 3 negative surprises. We can expand the chart here to look at that. So here are all the positive surprises. So we can see Turkey has done quite well. After reaching a low on the 21st of January, it actually went through a fairly strong run until last Friday's negative surprise. Of course, the question is, what drove that surprise? Is this signal or noise? We can also analyze the territory in which a surprise happens. So this particular case, Turkey is connected to Poland and Russia as having the strongest correlation. So there's obviously a question to see whether this is isolated to Turkey or whether this spreads. For example, we can see certain times in which these kinds of outliers spread across the network and across time. Let's examine the flash crash of August 2015. So we can navigate here back into this timeline, and I'm going to look at systematic risk back then. So before the flash crash, systematic risk was at 57%. We can see that there were already a few negative outliers on Wednesday. The UK surprised to the downside. Mexico was generally a negative day. The United States, let's look at the history there, has seen slightly greater than expected negative downside outliers, 6 over the last 100 days, than positive ones. And let's actually just navigate through this, and we can see how systematic risk can quickly escalate. So I'm going to go back to the network, and I'm going from Wednesday to Thursday, the 20th of August, and you can see a classic collapse of risk where its correlation matrix contracts. We have many markets here. We're going to look at 95% confidence outliers that surprised to the downside, with the US coming in at a 2.64 standard deviation move, which way exceeds the 99% confidence level. So this was an extremely unusual movement, and obviously sent shockwaves through the markets. We can see systematic risk starts to increase there. Let's walk through the next days. This was the prelude to the flash crash. We now have Friday the 21st of August. Systematic risk now spikes to a new high. 65% of the volatility is explained by one single factor. Here are the markets that surprised the most. So the US followed a 2.6 standard deviation move with a 2.7 standard deviation move. way outside of the bands that we would expect, way past the 99% confidence level. Something very serious is going on in U.S. markets. 2 days in a row that we've had such exceptional movements. And of course, then over the weekend, we see even more panic then as markets come back on Monday, and we can see this total compression in which global markets pretty much fall as one. You can see the U.S. had a 2.8 standard deviation crash on that Monday, so 3 trading days that cascaded into a downward spiral. So what you can see here is this correlation matrix that contracts, and systematic risk now spiking to 73%. Let's now expand this a little bit and look at the existing situation here of global equities. We're now in a situation where systematic risk is at 71%. So we're actually still close to flash crash levels, just 2 percentage points below flash crash levels. So this is something worth noting, that diversification benefit is very limited when everything is driven by systemic risk. The shape of the network is also interesting. We can see the US is at the center of the correlation matrix. The strongest link is to Europe and to Mexico. Mexico is the node that connects various resource countries, South Africa, Brazil, and other emerging markets, India. Asia is connected, is obviously the connection here to China, Japan, Asia ex-Japan, and Australia. And we can see here at the periphery China and Hong Kong, which has been driving a lot of the systemic risk. So I hope this was useful, and please tune in to further episodes of FNA Market Maps.